Thank you very much, Sean. Thank you very much, everyone. I'm so glad to have you on this beautiful Wednesday and for another session of RMS Smart Investing. Today, we're going to talk about a subject which is basically sounds a little mystical. There's a little mystery involved with it. There's a lot of misunderstandings. And so I thought it would be a good idea to basically talk about the foundation of this market, which is the futures market. We're going to dig deep, look at more of the specific characters of the futures market, which is really different than any other markets, and see how we can take advantage of that. And we look at the benefits of it, the advantages of it, and also we look at the risks. So with that in mind, I thought for the next 30 minutes, hopefully 30 minutes to 40 minutes, I try to squeeze everything in. We will, again, dig deep and take hopefully the mystery out of the way. And again, the goal is by end of our session, you would feel comfortable looking at the markets, and in the future, we can work on some of the strategies, how to take advantage of, again, the movement in these markets. So in today's session, again, we will talk about different underlinings of the futures market. Basically, I'm going to go through the list of the topics that I thought might be helpful of understanding the futures market, and we will go through them quickly, and then we can build on that. So basically, we start with the history of it, understand what is future and what is a futures contract for the participant in this market, the type of the contracts, the underlying assets. We will look at, as I mentioned, the benefits and advantages versus the risks. And since a lot of you are involved with options, we want to compare futures and options to see, what are the differences and what are the similarities. And I will emphasize the risk management, and that's probably the most important thing in any trading vehicle, but more so in the futures market. Then we will dig deep and look at the contract specs or the specifications of each contract. We see why each one of them are unique. We talk about the ticks, the sizes and the values, and what does even tick means. We look at the notional value, the settlement, they have the finite um, uh, life, and what are the settlements and how they get settled. We talk about lock limits, something different. So we want to look at that, what each contract has. And then we will look into the trading hours, which is one of the biggest advantages for the futures market. So we'll go in individual contracts, their trading hours, and the last but not least, how to choose a futures broker and some of the best futures brokers that you could use. So with that in mind, let's start with a little history. It seems like when we think about futures market, you can think of the pits, you can remember some of the movies if you've watched the Trading Places, or even some of the documentaries like Paul Tudor Jones's documentary. You see these people are shouting, but I actually, believe it or not, that the history goes back to 1750 BC, and it goes back to Mesopotamia, the Babylonian king, the Hammurabi, and he created this really first code of called Hammurabi, first code of like really trading the futures, and basically what he was allowing that people could sign a contract and deliver things in the future, and that's what the futures comes from. So you make a promise to deliver something or receive the delivery sometime in the future at the agreed upon price. So it goes from the fundamental idea, it goes to that era. But from more organized, as far as structured uh, history, we go back to 1710 with the rice traders in the Osaka, Japan, when they actually started an organized exchange to trade rice. So to kind of summarize it, it really started again in the 1700s, 1710 with the rice traders. But more recent, when we think of, look at again the movies, we think of the wheat and grain traders, we think of Chicago. So the first place really organized, like especially in the United States, was the Chicago, because it was the hub for the wheat traders. They would come, and the farmers will bring their wheat, and they will exchange for cash. And that's how in the 1840s started. And then by 1848, we had the Chicago Board of Trade established something with the forward contract, so it was exchanged between the two parties. And then eventually by 1861 and 1863, then we had more organized, because now the farmers could not bring their products. So they started talking about, well, let's have an exchange that we can make a promise, we can have a contract saying that, you know, when the harvesting is done, we're going to deliver. So you have a baker looking for, delivery of, or we talk about, let's say, cocoa or the Valentine's Day now, or again, the baker or the fuel jet for the airlines. These are all the things that it was used. And now, as I mentioned, because it started farming, they would say, okay, upon certain time, because of the so much uncertainty, that the futures market, the exchanges brought the certainty. And this way, the farmer was not worried about, going hungry, 6 months from now. And also Baker, for instance, knew that there is at a certain settled price, he could count on that, and he knew it's going to be delivered, the amount of the goods that they had settled. And then the financial futures, which we mostly are familiar with since you invest in stocks and bonds, which are the financial futures, they really didn't start till like 1970s. So basically a lot of things were the commodity oriented. So that's a little history. And there's a little picture from Chicago, the Chicago Board of Trade. As I mentioned, you've seen the hand gestures. Everything is electronic now, but I used to pay a lot of attention when we had the noises and how the trades were done in Chicago and New York, and it's really exciting to see the movements. And then this is the Chicago Board of Trade in 1930s, and again, you know, they all trading, offering, asking, bidding, and again, we don't have those days, but it has been, it's a historical, it's a part of our history. So, and now this is later when everything got electronics in the Chicago Mercantile Exchange, and obviously now it's less and less usage. So, what is a future? Well, basically, a future is a standardized derivative contract between two parties. Again, there's a buyer and there's a seller. So the buyer promises to receive the settle, whatever the goods are, and the seller is promising to deliver the goods. So that's basically what it is. Now, you have either they can work directly together, which basically, we call it forward contracts, so two parties, they work together. But a lot of times there could be misunderstandings, and especially there's like so many other people involved. And that's when there's something called the clearinghouse, or the exchange was created. So it brought the legal documents and standardized it. And this way there would not be miscommunications. People will abide by the rules. And this clearinghouse basically, they cover the potential liability by, usually just calculating on the mark to market, look at every day what the price was. So there would not be, again, any misunderstanding and between the two parties. If you recall, when we do the Forex, for instance, with Forex, there's no centralized exchange. With futures, which makes it more attractive in some ways, there is. So you do have that, again, protection. So what the futures contract does, again, we talked about, is the parties, it brings that mechanism so they are guaranteed that this contract will be honored. So you have that futures contract, and again, you have that clearinghouse, you have the exchange, which creates all the bylaws and all the rules. So basically, everybody follows a standard rule, and that's what's called the standard contract. So in that, everybody knows what is the size of the contract. They know what kind of assets have to be delivered, what month, And as far as where is it, if it's going to be physically delivered, what is it going to be? A lot of times, obviously, there's not delivery, and we will discuss about the players, how everybody's involved. And then basically what the traders do, they just negotiate the price depending on the markets. And it's always the supply and demand creates that. And that's how the futures contract is created. And you can see already there's like a difference between this and the other assets. Now, for the participants, and when we talk about the derivative market, which the futures is one of them, is basically, and derivatives means derived from another asset. So when we talk about options, options by itself has no value. It has an underlying asset, and that asset is the one creates this contract or this opportunity. So basically, it's more of a legal obligations on the both sides or one side, basically to deliver the promise. So futures are also a derivative. And basically, the participants in this derivative markets are mostly the institutions, the commercial, the banks, the FII, which are the foreign institutions that they invest. They are not domiciled in that whatever country it is. So there are foreign investors, the corporates, the brokers. So there's a lot of different types of people who are involved in the derivative markets. So basically what the number one, the goal is, and people ask, oh, why do we need the futures besides the commercials? The main reason the futures markets are made is for the hedging. The hedgers, what they do, they want to make sure that if they have a position, they want to reduce their risk towards that. Besides, again, the commercials, which we talked about, the delivery. So the hedgers, it plays a big role. When you're a fund manager, you can use the futures to protect against, let's say, currency exposure. You can hedge against interest rate movements. So that's why the futures market are huge. As far as the speculators are, then they're the people who want to take advantage of the movements and they're willing to take the risk. And it is more of a basically to take profits. And those are called speculators. And in this situation, it could be a retail investor, it could be a professional investor or trader, and that they try to use basically the movement of the markets. Now, then you have the arbitrageurs, with arbitrage, what those people do, they look at the difference of the markets simultaneously to see if there's any mispricing. And by mispricing, usually actually happens, believe it or not, in the currencies, for instance. So they buy something and they sell something and they try to just, it's a very quick, usually it's like the computer programs do that. They just want to take advantage of that little arbitrage. And then the last but not least is the spreaders, people who actually use the spreads. And it happens in, we've looked at it in options, but it happens a lot in the futures too. So basically they buy something and they sell something else. They use the spread. They could use different assets. Maybe they will buy gold and sell silver, for instance. There are times actually the movement, and again, in the future, we will look at a lot of strategies that you could use to basically use the spreads. It doesn't have to be the same asset. You can use, like with different months, you can actually use the spreads, for instance, even NASDAQ versus S&P, for instance. NASDAQ maybe is going down a lot faster, and or S&P maybe has a reversal. So you can sell one and buy another one, and this way you can actually have the spread that one might be dropping a lot faster than the other one. So you can basically make the money on the difference. So we'll discuss that. Again, my goal today is not really working on this, a lot of strategies or trading strategy. I just want to make sure you understand how the futures market works. Now, some of the actively traded futures contracts around the world, I mean, in North America, we know the CME Group. CME Group is the biggest one in Chicago Mercantile Exchange. So you have the agriculture, like a corn, a soybean, the 30-year treasury bonds, the 10-year treasury notes, and obviously we have the E-mini S&Ps and Dows and Eurodollar. So that's in North America, and then we look at the Mexican derivative exchange. The same with like Asia. I just want to give you a little reference. What are the biggest centers around the world? So it's not just, we talk about Chicago, it's not just Chicago. In many places, for instance, the oil is huge, crude oil, for instance, in the Middle East. So you have the Dubai, or when you go even, you think about palm oil, you think of like Malaysia has exchange for that, or in Tunisia, we think about canola oil, we think about rice exchanges. So it is a huge market. So now that we have a little understanding what actually futures contract is, what kind of assets can be used? As you recall, we said it's a derivative, so it drives some kind of asset, and there are multiple types of assets. There are agricultural commodities, metals, we look at energy, financials, the currency. So there are many, many different asset classes that you can use as an underlying tool and start using futures market on those. So there are two main ones. One of them are the financial futures that we, that include the, talk about 1970s, it really started picking up. It was taking off. It's the stock indexes, the currency markets, the interest rate products. And the other ones, which were really the start of really the futures market, were the agriculture, which is a physical that it could be delivered. So the agriculture, the softs, when we talk about softs, we're looking at like coffee or cocoa or orange juice, cotton. These are the soft commodities, which we had a class in the past. We call them breakfast commodities. We've also done on the other ones like agriculture, which are the grains, for instance, or like oats and wheat and corn and soybean. We've talked about metals in the past as far as analyzing the commodities, such as some of the precious metals like gold or silver or platinum, or we've talked about more of the industrial, we've talked about copper, and then energy markets are the crude oil and natural gas or heating oil. So basically there are two, and this one way of understanding how the futures market work, if you recall last May, for instance, with the crude oil delivery when we went to the negative, and there was no room for all these tankers, to store all this oil. That was all futures market related. So it's funny how 1 year makes a difference. Last May, there's this overwhelming supply, and now back east, they're talking about the shortage of, well, you figure that out. That's how times change. But that's what the futures market, the underlying assets are. I took a picture. I thought it would be interesting to see. This is from Finviz, which is available. So this is all the accessible futures market that you can actually trade in. So usually the top part is more of the stock indexes from Nikkei, which is the Japanese market, to Euro stocks and DAX, which is the German market, to Russell. And then you have the energy futures, which these are the futures, and these are the actual prices. So like crude oil early this morning was 65.29. Crude oil Brent was 68.54. So there's the gasoline, the Reebok gas, and then you have the heating oil and natural gas and ethanol. And then you go to the interest rates, which are the treasuries. So the bonds, the notes, and then you have 5-year and 2-year you can basically trade. And then we talk about soft commodities, which are cocoa and cotton and orange and coffee and sugar. And lumber is combined, it is with them, but it's like more of a forest. And then you have the precious metals and metals, such as gold and silver and platinum and copper and palladium. And then you have the livestock, which is live cattle, and you have feeder cattle, and then you have the lean hogs. And then we go into the agricultures, which is the soybean, and then you can have a derivative of the soybean, which drives that. It's like soybean meal and oil. Then you have corn and wheat and rough rice and oats and canola. Last but not least is your currencies. So the major currencies such as Japanese yen, British pound, euro, Australian dollar, Canadian dollar. So under one roof, these are all the asset classes that you can actually use as an underlying, and it goes even more. They have the subclasses, but these are the main ones. So basically that's why it's advantage to have trading futures because you have so many asset classes, but also some of them are completely unrelated. There's not correlation, so you really don't run out of ideas for trading, in my opinion. So, what are the benefits and risks of trading futures? And I think one of the things that is, as I mentioned, they're misunderstood is a lot of people obviously they don't want to get involved with the futures. And there's a good reason for it because of the risk. And we will emphasize the risk a lot. As you know, in my trading, which I've been doing for 30 plus years, it's the risk management is the number one. The position sizing, your money management is the most important thing. Strategies come, after facts. If you can manage your risks, even if you're 50-50 wrong, you still can make money in trading. So basically, you want to make sure that you manage the risk. So in this situation, the benefits of the futures market is they almost open 24 hours a day, and it can be very enticing, inviting because every second there is something happening. So it allows you to trade. So you don't have to be captive to be, let's say, 9:30 to 4 o'clock New York time. You have to trade certain time. They're almost open again 24 hours a day. Now, there's also options on the futures, which is like in other stocks, other derivatives, options on other asset classes, but the futures are available. You can invest in, and you have, as I mentioned, there's just a variety of asset classes. Now the risk is it basically is the leverage, and because of that leverage, which could be pretty unlimited. I mean, it's a lot of leverage. Managing the risk becomes the most important, and I will continuously and emphasize that. The contracts, if they have settlement date, they do expire, and they have certain period that you have to watch for that. And each contract, each trade, the futures, they have their own specific um, characters. They have their own tick size. They have their own expiration dates. So because of that, you have to really understand it before you get involved with it. You really want to know the mechanics, and you want to do the nuts and bolts. So it's not just taking a shot in the dark and thinking, okay, S&P is going up, I'm going to jump on it. So basically, again, main thing, the risk is managing it and understanding it. So let's talk about, because we are, most of us are familiar with the stock market. So I thought let's focus on the E-mini, the S&P futures, which is that's S&P 500, and the cash market follows it very closely. They're very close, which is the SPX. So let's look at some of the advantages that trading this S&P futures offer, and why again it's enticing to understand a little more about futures and start trading it. So number one thing is the market efficiency. The ask and bid is very tight when it comes to futures trading, especially in the E-minis. So really, the commissions are very low, but also the bid and ask, because of in such large trades so much, it's very efficient. The leverage, you don't have to have a lot of money. Let's say you have a small account, which is a mixed blessings. Because of that leverage, you can go basically you can be as aggressive, but also quickly you can be in the hole. There is no, like we will compare it with options, there is no really a safety net. The safety net is you with your discipline. So I've seen people that they have lost their houses, they've lost their family because they did not manage their risk. And I have many stories that I mean personally I've seen how people became reckless, and they looked at it as a gambling and trying to make the money back, rather than looking at it as a business, as a trading tool to build on it. That again, they didn't manage their risk. So, but leverage is very important because with small accounts you can control a lot. One attractive thing is that there's no pattern day trader. A lot of small investors, they're concerned. They have a great understanding of the markets. They're very good traders. Unfortunately, well, capital plays a role. So, for instance, if you are gonna buy stocks and sell them as a day trader, if you have don't have more than $25,000, you really cannot do more than three trades trades a week. So it kind of limits. In some ways, it's good because you want to be really get the quality investments. If you're in swing trading, you want to be really quality, but it hinders. Sometimes you have so many great ideas. So with futures trades, you don't have that. So no pattern day trading. Lots of liquidity, and you will see what I mean by that in the future slides. It's very liquid markets. Again, E-mini is constantly being traded. There's a tax advantage, which will go more deeper on that about futures market. And as I mentioned, it's almost 24 hours a day is traded. They take very small, 1 hour and 15 minutes, for instance, for S&P futures break. You are allowed to trade for 22 hours and 45 minutes. Middle of the night, you can't sleep, you don't know what to do. Now, again, it could be a blessing. It could be also not a very good idea if you're in the middle of night in a good mood, you have a lot of thoughts. It's not a good time. But hey, there have been times that I've traded, you know, in the evening, and it had made my whole week. So it takes the pressure away. It's just the availability of that. And there's no interest charge. When you're day trading, you don't have to pay interest on, as far as getting and getting out, in and out. There is no such a thing. And nowadays, everything is done electronically. So it's very quick. Everything is done, and you can be in and out very quickly. I mentioned about tax advantage, and that's one that's very unique to the futures market. So the futures trading, it has the following tax advantages. It is something called, it's a code, tax code is 1256. What that says, the futures market, regardless of you in it for a second or in it for a year and a half, whatever investments that you have in the futures, which is usually futures market, because they have the finite life, it's always short-term to intermediate term. You do have this code of, regardless of the gains, 60% is always get treated as a long-term capital gains, and only 40% is a short-term. So just think of it, if you are in a high tax bracket, let's say you're looking at 37%, for instance, 37.5, and then with the state, if you add it, if you live in California, New York, sometimes you look at 50%. That makes a huge difference. So that's important. Although there has been talks with the new tax proposal, they might want to get away from it, but it hasn't been done, so it is very attractive. The other good thing is you don't have to keep the track of your trades. What happens, with stocks, as you know, you really have to go line by line. You do it on Schedule D1, or you've got to write down when you bought it, when you sold it. With this, your broker, end of the year, or beginning of the next following year, they just send you a piece of it, 1099, just says, this was your base, this was what you sold at, this is your total profit. That's it. You could have had, I know I had one day, I had over 2,000 trades in one day. I mean, imagine trying to keep the records on that. But the brokers do it for you, so it's a simplicity, and you can adjust your losses back up to 3 years. So, and there is no wash sales. I mean, everything is done for you, and it's very simple. So that's a big advantage. Now, one of the things about futures contract is we have to understand, because of that leverage, there's a margin requirement. So each asset class has its own underlying asset, its own margin requirements. And it's the exchange, which, let's say in Chicago Mercantile Exchange, they're the one who come and decide, listen, this have to be the minimum margin. And then brokers, they can work on that. Some brokers will ask more, some brokers will ask the same. So basically, brokers can negotiate. It's the risk that they're taking. So they want to have a good faith amount of money in it when you put the money in as a contract to purchase something or sell something, they want to have you have the means to up to amount to protect that. So that's called margin. So it's almost, as I mentioned, it's a good faith deposit. It's like a bond to ensure that there is enough money to provide for that. Now, the initial margin is the minimum amount to initiate the trade. So you have to have it. So for instance, if you want to do like a Bitcoin trade, just use that Bitcoin futures, and you have a $5,000 account, well, you cannot do that. You cannot do, for instance, if you have a $2,000 account, you cannot do E-mini. You have to have enough initial amount in order to do that. We will look at the next slide. You will see that the exchanges are really getting smarter, so they want to get more investors and traders involved. So the traders, so they have come up with the micro, for instance, which takes 1/10. So let's have like a micro E-mini, which you will see. So now you require like 1/10 of the margin, so you can actually start trading without taking a lot of risk with small capital. So that's initial. Then you have the maintenance, and basically, if you're in a trade, you want to have that amount of money available. So again, you want to make sure you're protected. So what happens is with the day trading, that's why it's a good idea to know your hours. Basically, if you're day trading, and we will see the hours, you need a lot less than overnight trading. So that's why it's important to know, let's say if you're doing E-mini S&P and the clock, the markets close at 2 p.m. Pacific time, for instance, if it closes at 2 p.m., at 3 p.m. is the next day. So if you didn't close your trade by 2 p.m., then your requirements almost going to be tripled. So basically, you want to either make sure if you're doing day trading, maybe you can close and open it again at 3 o'clock. So this way, you are not losing your purchasing power in the sense of investment power. So the overnight is always more than your day trading margins. So keep those in mind. So believe it or not, at 3:01, the new day has started. So you can be in that trade, be in and out, and pay a lot, require a lot less margin till like 2 p.m. 2 p.m. Pacific Coast time in this case, or 4 p.m. Central time next day. So for, in this case, almost 23 hours, you can basically be in and out with almost a triple the power. So keep that in mind. Now, what margin call is, it's when your margin level, when you that maintenance, that remember that they were asking you, the broker required, and exchanges have the guideline that if it goes below that, then two things happen. Either your contract will be liquidated, or if your broker is going to call and say, hey, we need more money, you got to put more money in. And that's the danger. You hear like about margin calls. What happens with the stock market, like with the futures, really, because what happens, people have been investing, they've been either on the stocks they've been doing on a margin, they've been borrowing to buy that stock, or they've been doing the futures, and you hear about these horror stories that because the markets were going down, and because they didn't have enough or sufficient funds in their accounts, the brokers are forced to sell their other assets. And that's why we call, like, there's like a margin call Mondays. Mondays can get ugly. So if just right now where we are, so let's say the selling continued, which we went through like last March, for instance, if you recall, in 2020, when the calls are happening and the markets are going, and it's Friday and the market's still going down, usually one of the reasons you hear about horror Mondays, because a lot of crashes you hear is at Monday, because margin calls are coming in and there's panic. So in order to provide for this, you're forced to sell your good assets. There's a question, for instance, why if stock market futures are going down, gold should go up, because that's the risk, or even bonds, they should go up because they're the risk off assets, they're like insurance, but yet they go down as well because of, could be because of the margin calls, because in order to protect and provide liquidity, they have to sell their other assets, which has nothing to do with the market. So I hope that clarifies that. So that's the reason sometimes unrelated assets, they're sold at the same time. So talking about assets, we talk about most of you are familiar with options. So let's compare what is futures compared to options. Again, since you're familiar with options, when we talk about futures, we're talking about two counterparties which are using an exchange to make sure they abide by it. And they are saying that there will be a predetermined price will be at that specific time, we call it the settlement date, it will be delivered. It's the same with the options. We have someone who has a right to buy, not obligated to buy. He has the right to buy or sell an instrument at, again, at a predetermined or decided price. Now, it could be expired or it could be executed before. With the futures, it's the date of the settlement date that it will be done. So there's a difference right there. The level of risk, again, is because of risk management. The futures is very high. With the options, in this situation, what we are looking at is more of you are a long, whereas a debit. So it is restricted to premium paid. So you can compare it if you had a naked call, for instance, not even naked put. With the naked put, at least the market goes to zero. So you still have the predetermined. With the naked call, it could go indefinitely. The problem with the futures are because of that leverage, the markets can go as high as, and they can move very fast. So all of a sudden, you can quickly owe a lot of money. So basically, that's why the futures markets could be, again, pretty risky. As far as the buyer's obligation, again, we are looking at with the options, we are the buyer, so we have no obligation. Basically, all the things we just pay the premium. We don't have to exercise our option. With the futures, you are. So it's a two-sided thing. They have to both honor the obligation. The seller's obligation is, again, the complete obligation. It's a delivery. They have to do it. But as far as the options, it could be exercised if the buyer wants to, or sometimes they don't want to exercise. So it is, but still, the seller has that obligations to deliver if it has to be. With the futures, there's no questions. Both sides have to honor. Now, payment in advance, that's the beauty of the futures, really, as long as you have the margin and you have to pay just a tiny bit of commissions. If you have that money in your account, they don't take that money and spend it. That money is, again, I mentioned, it's a goodwill kind of a deposit. With the, obviously, with the, again, we're talking mostly debit. With the options, you just pay that premium, and that's deducted. So basically, that's the difference again. Now, as far as a gain and loss, there's no restrictions. And as we mentioned, this is mostly talking about a debit, let's say directional or even vertical debit, is even you can look at it that even if you did verticals, you could have limited profit or limited risk. But mostly this is, we're talking about directional. So if you're long, the call, you have unlimited profit potentially, but limited loss because of the premium you pay. Now the date of the execution is contract, all of the contract as Sandra, so you already know when is settled. And but with the options, you can do it anytime. So any point of time before the date of expiration. And the last thing is the time value of the money. It's very important. When you do the options, we've talked about the time decay, we talked about the time value. So it's a depreciating assets when you think about, again, you're talking about long call, for instance, or put, when you're buying, it's a depreciating asset, so the time is against you. But in futures, there's no such a thing. So it's not that complications. It's very straightforward. It's, again, it's the buyer and seller agreed price based on the market. Again, you can get in, get out. It could be more expensive 2 months from now, or it could be a lot less worth 2 months from now. So risk management, please. This is there's nothing different between the risk management as far as the any assets, but it is very, very crucial because of, again, unlimitedness. You really have to be totally disciplined when you do um, futures market. And that's what I suggest to, a lot of traders. Futures markets should be toward the end. You really first master yourself, and that's for like investing in equities and investing in stocks and bonds is a good start. Options, in my opinion, if you know the strategies could be very um, defined because of the defined risk, it's mathematically oriented. So I really like options because of so many different strategies that you can actually limit your risk. Futures market is all about you. It's all about your personality. It's about your mindset, and just again, it is a mixed blessings because you have so much potential for profit as well as so much for loss. And if you don't manage it well, unfortunately, it if you've done naked sells on options, this is you have to multiply this. And one of the problems which I've done, I've shared the story before, there's operational risk because if you don't have the discipline, you don't have done the right mechanics as far as your stop losses from, for instance, with the futures, it could be like when the markets move, which it has happened. If some of you were trading like when we had the flash crash, when the markets drop, it puts a lot of pressure on your trading platform, and sometimes you cannot really execute. And you call your broker, and things are really happening so fast. So if you cannot manage it, and the last couple of days when I was doing my trades, a couple of times my computer froze, so I had to have a backup plan. And because of that, you really want to make sure everything is in place the correct way. I shared this story with you is, remember, we talked about, I just used that E-mini, right? The 2 p.m. Pacific Coast time or 4 p.m. or 5 p.m. New York time, the markets close. So let's say it's 1:55 Pacific Coast time. I put a trade in and I put my stop loss thinking that, oh, this is great. I put my stop loss, I go have a bite to eat, and then I come back and I see, my God, the markets have gone completely away from me and I'm losing a lot of money. And I say, well, did put my stop loss in there. What happened? Well, remember at 3 o'clock, the next day has started. The stop loss I did, most likely I did for the day rather than good till canceled. So these little things can come back and haunt you, especially in a fast moving market. So these are little things, but they're very important. So risk management is rule number 1, 2, 3, very much so in futures market. Okay, now there's something called contract specs. So this is again something unique for the futures, and because you have different kinds of futures, you have the financial futures, and then you have the commodities. We talked about grains. You have the precious or the metals. You have the energy. You have soft commodities, and then you have like currency. So each one has its own unique characteristics. So rather than me going to every one of them, I thought, let me give you one example so you can understand what it means. And based on that, you can go on actually the CME group, which is again the Chicago Mercantile Exchange website, and you can look at all the specifics. Or I have an example how you can, even if you have like Thinkorswim, a lot of platforms have it readily available. They provide all this for you. So, but let's study this all together so you will have a little more understanding what it means to have a futures contract, and then you can apply to every other underlying asset. So now the contract unit, and we will talk about the ticks and the tick sizes and the value, is what happens one point in that underlying. In this case is S&P 500. So let's say S&P is at, I just use simple number at 4,000. So if it goes from 4,000 to 4,001, that $1 movement, how much money is in my pocket? And basically, if it moves $1 up, it's $50. If it goes down $1, I lost $50. And that's what you have, that the margin requirement. So they're sitting on the side. They want to make sure if you have 3,000, well, like let's say they require 12,000. So they want to make sure that you don't lose beyond the 12,000, for instance. So, but this is important. This is where the tick value comes. So every point in S&P, $1 move is $50. And it is basically, if you're doing euro, so that's what if you're in London, you're doing exchanges there, or euro, each one has its own currency. Now, because you're doing S&P in the United States, it's a dollar denominated. So, and the quotation is in the dollar and cent. So because the movement is $0.25, for instance. They call it ticks. We will discuss that. So as far as the trading hours, basically I've put every single contract trading hours at the end of our presentation, but let me just explain it to you. So basically the market's open on Sunday. This is 6 p.m. It's a East Coast time it uses, so it's at 3 p.m. West Coast time, and it closes, as I mentioned, at 2 p.m. Pacific time, or the 5 p.m. East Coast time. So you can see it's 23 hours. There's one little thing you have to remember, and that's, again, little things that you have to know, is that 4:15 East Coast time, or 1:15, they take a 15-minute break. So the cash market closes at 4 p.m. New York time. The futures continue till 1:15 or 4:15 actually. Then there's this 15-minute break. So, but the day continues. So you have another 30 minutes, and that 15 minutes that they do, and that 1 hour, they do the adjustments. Is operational. They evaluate all the computing and all that. So it's good. You want to have that little break. Make sure everything, the exchange, everything is operational. So they do the maintenance kind of thing. So that's 15 minutes. So let's assume, for instance, tomorrow Disney comes with earnings, or 2 weeks ago we had all the big techs, or last week we had all the big techs, for instance. The last 2 weeks they've been coming out Tuesday, Wednesday, Thursday. After hours, you cannot do cash trade. You can do some of the after hours, individual stocks, but you can do futures. So at 1:30, you say, well, the market is going up. Let me, for the next half an hour, I can do S&P because there were a lot of good earnings came, or a lot of bad earnings. Let me short the market. So that's the beauty of that. So as far as the CME, just gives you the hours. Again, they're open from 6 to 5 p.m. Minimum price fluctuations, that's the tick size and tick value. So the S&P, $1, the smallest value is 0.25. That means a quarter. It moves, used at 4,000. So it goes 4,000. The next tick, which is the smallest movement, is 4,000 and a quarter, 4,000.25. Then it's 4,000.50, 0.75, and it goes to 1. So what that means, if that $1 was $50 value, then one tick would be 50 divided by 4, which is $12.50. So if I got into a trade right now at 4,000, and my S&P went from 4,000 to 4,000.25, for instance, basically I make $12.50 if I want to sell it. So as far as now, these are the spreads that we are not going to go too deep. So when we get to the spreads, we will discuss those. And then the products. So each contracts, they have their own little symbol. So if, let's say, you do Thinkorswim, every platform has all these, so you will know, and it's written in front of it. So all of these are available through platforms. So for just the interest of time, it's already supposed to be 30 minutes. It's futures in 30 minutes, but we already like 50 minutes into it. Just know that these are the indicator of what is for S&P 500. And then they have their settlements, which is quarterly, so every third Friday of literally seasons. So it's like in March, in June, September, and December, they basically they settle. So that contract expires, and the settlement method means financial. So nobody comes and delivers a physical S&P 500, um, you know, stocks. They don't bring all these stocks. So it is financially. That means really it's cashed. So you receive, it's just settles. So you receive whatever your gains are. So and basically that's about it. So interest time. So this is my thinkorswim. You go and you look at the trades, for instance, and you just go to just put any symbol here, and then this. So let me make it larger here. So when you did it, it shows you can go it's all the symbols that you have available. You can go recent is the ones that you've been looking at. Again, this is on toss. If they have positions, and then you just click on the futures. So when you click on the futures, alphabetically, everything is here for you. So you can just scroll down whatever you're interested. So since we're talking about E-mini S&Ps, for instance, this tells you, it gives you all the specs we just talked about. So you don't really have to do a lot of different studies. You can see, for instance, in thinkorswim, as of last night or this morning, that your ticks are 0.25. That's the minimum movement it will have. And every 0.25 will make you $12.50. So as I mentioned, $1 is 4 times 0.25. So 12.50 times 4 is $12.50. Now, TD Ameritrade or thinkorswim, they require for you to have $12,100 in your account for initial margin to be able to trade one contract of E-mini. And let's say you want to do gold. Gold, let's say we look at the, as far as the price of gold, let's say it's $1,832.20. So it moves on dimes or 10 cents at the time of $0.1. So every 0.1 it moves, you make $10. $1 is 10 times 0.1. So 1 point in gold is 10 times 10, which is $100. So if gold goes from 1832 to 1833, you just made $100. So if it moves 3 points, then you make 300. If it goes down 3 points, you lose 300. And your requirements is 9,900. So you have to have that initial margin. On the other hand, what you can see, like Eurodollar futures in this case, or the feeder cattle, each one of them, they have their own margin requirements. Some are more, some are less, and these are currencies. So everything is spelled out for you. So I hope just by using this example, maybe you can tonight or anytime, you can actually have more clarification how these things work. So based on that, then hopefully it's easier to be a little more comfortable with the future. So one of the things the exchanges did, the Chicago Exchange, they came and said, well, a lot of people don't have, let's say, 14,000 in their accounts, so let's offer them something called micro. So as you can see, that micro is 1/10 of the E-mini. So if you recall, $1 move in E-mini was $50. Because this is 1/10, if S&P goes up $1, you make $5. Now, one of the interesting things is because we emphasize on risk management, a lot of people, if you're starting with futures market, it's the best to use micro S&P. As you recall, last weekend, the previous weekend, we had the micro Bitcoin started. So these allow you to have lesser margins, lesser initial margins requirement. And if you're losing, or if your trade is losing, you have much less risk. So this is almost like doing a paper trade, but if it's with real money, you still can afford to put lose 20 points in S&P and only lose $100 versus $1,000 in your trade. Now, as you can see, that the overnight margin is much higher than intraday, and that's what I was saying. Watch those. So, for instance, you only need $173 intraday margin, which is like day trading. But if you miss that 2 o'clock to 3 o'clock and it goes next day, it's quadrupled. So close that. So usually it's about 3 times generally. This is the same thing. We have micro NASDAQ, Dow, Russell 2000. And if you want to do futures, you could also do and the gold. So as you can see, these are pretty attractive if you ever want to get involved gradually. I already talked about tick size. So that's the smallest movement on the price of your underlying contract. So as I mentioned, the smallest tick for S&P, mini S&P was 0.25. And in order to have a value on it, then you just multiply by what is each tick's value. So if it's one movement in S&P was $50, then divided by 4, each tick will be $12.50. I hope that's clear. I just have a little more ideas. So YM, for instance, it moves at $1 at a time. So every time you hear like, oh, it's at 33,000, let's say, it goes 33,001, you just made $5. 2, that's $10. So I hope this is helpful. I just want to give you more reference, just in the interest of the time. I just want to make sure you are getting more comfortable with this. And there's more examples here. How, for instance, the currencies do. What is the sugar? So for instance, sugars, it's the smallest 1/10 of 1,000 it moves. So it's $11.20. So every 1/10 of 1,000 movement, you make $11.20. About, again, of interest, you have access to the slides, so you can actually use it as a reference center. I want to give you even more reference so you can see the currencies, energy, metals, grains, how each one used. So for instance, corns is a $50. For every penny that it moves, you make $50. So I used to do a lot with corn and wheat. Corn is the most conservative of all the grains. So if you want to start, for instance, with any type of grain, I would start with corn. Soybean is the most aggressive and moves faster. So for every dollar moving corn, every penny, you will make 50. The smallest is a quarter, and it's very similar to E-mini S&P numbers. So the notional value, this tells you how much you really have control when you put that little initial margins. In reality, because remember, every unit is $50 for $1 moving ES, and let's say S&P today was 4,100. It's really one S&P contract is $205,000 value, and that's what your margin is controlling the movement on this. So notional value is important, which is this unit times the spot price. So just tell you how important this is as of April 2021, last month. It tells you how much of a notional value is traded on a daily basis. So agriculture is about $70 billion, energy is 104, and equity indexes are 644 billion, and our FX is 65 billion, and then interest rates are $3.8 trillion. That's why it's so important to know the value of the interest rate futures. Now, one of the food for thought is, at 12 o'clock, the futures trade stops trading, and then especially when you have the pit traders, a lot of these interest rate traders come to the equities, and the last hour becomes very crucial. So, but there's a lot more activity in trading interest rates than equity. But again, equity is like very sexy. People love stock markets. So, and then metals are not as big. And then the broker tech and EBS, these are all the customer-oriented exchanges that they deal directly with other traders or the dealers. So they actually are more of a private dealers in a sense, and they do 669 billion. The same thing with OTC clearing. So you see how much of our activities are happening. Now, as far as the calendar, what I mean is the settlement. So again, I'm emphasizing E-mini. Now the soybean, the grains have their own, they have the letters that we use, but again, um, what I'm emphasizing on the E-mini. So for instance, we always, well, most of the time, the most liquid one are the nearest futures contract. As you recall, we had 4 settlement dates for the futures contract. And the way it's written, M stands, so there's 4 letters. So um, H is for March, M is for June, and then we have U is for September, and then you have Z for December. So usually the most recent one is the most liquid. So if I'm trading today, if I want to do E-mini, I will use the symbol. It will be June 21. This is the year, and this is the month. So it will be traded till the third Friday of June, which is June 18th. But the activities are rolling because now after that we will go to September, which is the U. Usually starts about the previous Friday, and Monday gradually everything moves, and Thursday is really everything has come together, and we've talked about that in the past. So Thursday moves to really to the next settlement day, and you will see the split in the volume. By Friday they have more volume in September than June, and then by following week gradually everything has been rolled or settled. So that's very important to understand. So as you go farther, and that's what the spread comes, you can play spreads. As you go farther, what happens is there's less and less liquidity because we're going so much farther in the future. We don't know what's going to happen. So a lot of things happen unless you have a commercial, or the hedgers, maybe they have delivered something in September, they want to protect themselves, then they use that contract. The other things we haven't talked about in the past, we've talked about is the backwardation and contango. And contango, when the prices actually go down as the time goes longer, and you have to, you know, I'm sorry, that contango is when the prices go up as the time goes up. So when you roll it, you have to pay a higher price. Backwardation is when the near month is higher than the later months, so you can roll it and buy less and less. And usually that means there's a lot of positivity for the near future. There's a lot more demand. So that's usually a bullish outlook. So anyway, the lock limits are very unique to, again, in the futures market. We've talked about there's the New York circuit breakers, and in the futures market, each asset has their limit. So we talk about like last March, we hit that. So basically, if the markets move 7%, 13%, 20%, then the exchanges will freeze. So I've used, the guidelines. So, but like in grains, for instance, and it has hit me actually a few times, then you hear if the markets move up so much, then they will actually halt, and they call it, like, if it goes down, we call it limit down or limit up, and then there's no trading. So we have to come back the next day. We make sure everything's settled. So the next day, if it does the same thing, goes down, let's say 30 points, like in corn is like 7%. If that goes down, for instance, then they will halt it again. So sometimes you cannot do anything because as soon as it opens, it comes down. So that's what it talks about risk management. Please make sure, basically, your risks are pretty much controlled, because limit downs and limit ups do happen, and I've gone through them. So limit up, let's say you shorted the market and keep limiting up, you can't do anything about it. It happens so fast. So that's very important to understand your limits, what the price limits are, what is a lockdown. Again, this is to protect, to make sure the speculators are not really taking advantage of this and pushing the prices so much lower. So they want some kind of sanity to make sure people have time to digest what's going on. And as I mentioned, we hit the circuit breakers, for instance, last March. It happened, I think that the culprit for all this was like 1987 when we had that, uh, October 19th, and markets Dow Jones dropped 22.3%, 508 points. That's when they came up with the circuit breakers to protect the investors. So that's important. I wanted to give you, for instance, an example. You can go on CME. I just typed the S&P. So for instance, for S&P, E-mini 500, which is ESM1, which is a June 21, you can see, let's say the price was, just put 2 decimal points. So we were at 4,146, and they give you the rules already. They tell you what the 7% rule will be. The down limit will be 3,855. The 13% will be 3,606, and then the 20% will be 3,316. That means if it goes down there, then they're just going to halt it. So I hope that helps to understand. We're almost toward the end, so I just want to review again. You have access to all of these. The futures trading, we've talked about it. So I kind of separated, like for stock indexes, what are the hours? These are all central time, so make sure you understand actually. Yeah, these are all central time. So just make sure you understand, because it comes from Chicago Mercantile Exchange. So 5 p.m. Is 3 p.m. Pacific Coast time, or 6 p.m. New York time. So the same thing with interest rates. Just follow metals. I have all the, again, the hours for your reference. Energy. These are all the contracts available. Grains, the softs. Basically all the currencies. That's one thing about the Forex and the futures. With the futures, again, you are actually doing the future on that specific currency. You don't have cross currencies, for instance. But what happens is you actually see the volume. You can do options on them. So in this situation, you see British pound as you can trade options. With Forex, well, there's no options available. Or for instance, in Europe, you can do options. So those are some of the attractiveness about the futures market. And technical analysis point of view, it's a little different than if you do the Forex analysis. Livestock is, I mentioned, feeder cattle, lean hogs, and live cattle. Forest, well, you know the story about lumber. Imagine if you would have been playing futures on lumber. It's not very liquid in some ways, but still, you could have traded in since last April, for instance. I think almost we are done with our slides. I thought, you want to make sure the brokers that you choose, this is very important. I know I've shown you the best traders, and I wanted to share that with you. But make sure any futures trading that you do not do a web-based trading. Make sure you have a platform, downloadable platform to trade. A lot of things can go wrong when it's on the web-based. So that's rule number one. So whoever you choose, make sure they have their platform. They can offer you a lot of, again, customer service. I think that the futures is more than anything else. I use 3 different brokers for, again, as a backup. Well, one of them is in Chicago. It's great. For instance, with Thinkorswim, sometimes I cannot reach my broker with the, like, let's say with Infinity Brokerage, they have a person assigned specifically for you. So you have your own specific broker. Things go wrong, immediately I call. I say, well, we got to take care of this. My trade didn't go through. Or so those are important. That personal, again, with the futures, things move so fast. But as far as, again, this is by stockbrokers.com for 2021. These are the, the top. Of course, I use the TOS or TD Ameritrade, and the TradeStation, which I use both of them, and they have great platforms. And last but not least, all the futures market, that's another important thing. They do have oversight on regulations like SEC for the stocks and FINRA for the advisors. The same thing with the futures, you have oversight enforcement. If your broker did something wrong, you can go to CFTC or NFA, National Futures Associations. So with that in mind, I very much appreciate your patience. I hope it was helpful. I hope it was something that gives you a little more confidence and also comfort to know that things are possible. You can actually, if you'd like to start nibbling at least, maybe paper trading with the futures market. With that in mind, I very much appreciate it. Sean, we can stop the recording and answer any questions that there is.